Hello to all the beautiful legends watching this channel. Today we're talking about the ultimate crypto trading guide that is not fully in-depth, but it mostly gives you one rule of thumb to just make crazy amounts of profit over the next few months. It's just one simple crypto trading strategy that, since the inception of crypto, has always worked, is extremely simple to execute, and is basically foolproof, with the only downside being either extremely bad judgment / risk management. And to expand upon that judgment, if you doubt the strategy works, it will probably not work for you. But everything will become clear over the next few minutes, so make sure you go ahead and press that like button and watch on, as this ultimately is the only one crypto trading strategy that you need. And it's all based on this one thing: the crypto bull and bear cycle. I mean, on the channel, I've talked about it 1,000 different times. There are different phases to a bull market. Some points you're going up, at some points you're going down. And we often say in a cycle, it's usually Bitcoin first, or the main cryptocurrency, then Ethereum, so the second largest crypto, and then some other large ones, and then smaller and smaller, in that exact order. And I mean, quite recently, indeed, Bitcoin was the best one to buy, if you exclude some miscellaneous random altcoins. But the general rule of thumb, Bitcoin has been one of the best ones to buy, and that's kind of what this all plays into. But anyway, to expand upon the strategy, and in the simplest form how it works is, we go onto an exchange, preferably one that has leverage, like for example Bybit, and depending on where we are in the cycle, we either buy or sell. Now that sounds very simple and too generic. What do I mean? Well, I'll expand. I'm just saying we need a crypto exchange to do this all on. The one I personally always go for is Bybit. I've also left the link down below to OKX and a few other ones you can try out. But the rule of thumb is as follows. We believe that there are roughly 50 weeks of downward pressure on the Bitcoin price. This is where your price just comes down like crazy, where the price basically falls 80 or something % for literally a year in a row. And that's the time where you obviously should not be buying unless you've got a different strategy. But generally speaking, this is where you stay away from everything crypto related, or you short. But for the most part, you have a dollar position. And again, you can play with that by shorting in the meantime. But let's just say you stay away in this roughly 1 year period where prices come down like crazy, denominated here in the red. And thus far, it's always been roughly a year plus minus, let's say, a month or two. But that's the least interesting part. It's the accumulation and bull, because right now you can see officially between these orange lines, these are the halvings. This is where the Bitcoin, oh, I think the camera just died. Anyway, these little orange lines that you just saw, or in the grand scheme of things here, these white lines are basically where the Bitcoin mining rewards half. And it basically increases the perception of scarcity with Bitcoin, because the new Bitcoin coming into the system are coming in basically half as slow, or half as fast, I should say. Many theorists believe that that's what you call a cycle, because this is a 4-year period in which some very, very similar pieces of price action happen every single time. And it's as follows: about a year of downside pressure, then accumulation phase of, in this case here, roughly 70, let's say 70 to 80 weeks. But then that's basically the end of the cycle. And this is from the first measurement back in 2013. Let's just start the theory at back in 2016. So the first roughly 70 weeks are raging bull market. This is where the price never closes a candle below the 1 weekly 50 moving average. That's basically the 50 weeks average. It never goes below that price throughout this entire 75-week period here. And the idea is really as follows. You basically buy for whatever, the first, let's say 50 or so weeks. And after the first 50 weeks of it, you start thinking about selling of this crazy bull phase of 70 weeks. I'll add though that you don't actually have to do that. You could even, for the first 70 weeks, right? We'll see about why in just a second. But even for the first 70 weeks, just buy, for example, Bitcoin. And at the last stages, like let's say the last 10 weeks or so, mostly just focus on altcoins. Because the moment this bear starts, that's usually where altcoins still have a crazy run up for a little bit. It's only after a few weeks in that Bitcoin goes down so much that the altcoins start to really fall as well. Anyway, so again, the theory is as follows. You buy basically within this first 70-week period after a new cycle. So let's see. We went down roughly 85%. We went up ever so slightly, but this is basically the area where you really start to purchase, where you really start to get into everything. But hey, that period, unfortunately for this cycle, has already gone. In this cycle right now, we are, I'm going to say roughly here. If you're watching this video in July, we'll see in a second how far in we are though. The bull, as I just stated right now, if you put it simply, you can just keep on buying as well for the first, let's say 50 to 60 weeks almost for sure. It's only the last, from 60 weeks on forward, you start questioning exactly whether or not it should be Bitcoin or some crazier altcoins. That's not to say you can't buy altcoins sooner. I'm just saying this is one of the most foolproof theories because it works the same exact way every single time. Again, 70 weeks of up, 50 weeks of down, 70 weeks of up, and then 70 weeks of crazy bull market up. In this case, here's 79. Then again, roughly 55 or 58 weeks here of down, 70 weeks up. And now let's see, because this is all the way back in, let's see, they posted this in January. If we quickly zoom it through, you can see it was roughly 70 weeks of good up. Then now the halving comes along, which is right here, this orange line. And from here on forward, it's most likely going to go pretty crazy up over the next, let's say, 70 weeks. And so the idea is to just, as we keep crawling along over the next few months, just like in previous times, all we got to do is just believe that this time it won't be much different than ever since Bitcoin incepted. Again, you have to understand that Bitcoin, wherever you bought it at, has always gone up because we're basically at all-time high prices, right? We're $10,000 below it, but we're basically at the highest points ever. As long as you do not believe that Bitcoin is dead, there's a very good chance that this sort of pattern will keep repeating itself. Just like how with the stock market, with index funds, if you just kept on buying, over a rolling period of a few years, you will always be up a ton, at least thus far and since the inception of the S&P. That may at some point change, just like how the fundamentals of Bitcoin just may change at some point. And that's where I said, if you do not believe that Bitcoin is here to stay, and that over a longer period of time, even if we say the next decade is going to go up, or you don't believe at all that every cycle has at least some similarities and that the past couple of cycles here, it's all just a coincidence, it's probably not going to work the same way, even though clearly there are some signs that showcase that indeed it is not the exact same. Because here, for example, we had two really close by tops, whereas in 2017, we only had one major top. So again, it will not be exactly the same, but at least to some extent similar, with again, about 50 weeks of down, 150 weeks of up. So this is again, bear market is about a year down, bull market is about 3 years of up, bear market is again about a year of down, then again, bull market is roughly 3 years of up, bear market again, 1 year of down, and then right there, all the way back in November or so of 2022, let's say, the new 3-year cycle started, where again, roughly 150 weeks of up are expected. The exact highest point in terms of price is hard to say. I mean, Bitcoin could top out at 250,000. It could top out at 115,000. We do not exactly know where the end of it is going to be. But so my trading strategy is really simple. It's either you open a leveraged position with, for example, cross, or just buy at spot. And the difference there being with and I'll show you how to do it, by the way. But the difference being with a leveraged position, you can obviously get every move that the Bitcoin price makes as a heavier piece of profit. Whereas with spot, if you put in $1,000 and the Bitcoin price goes up 1%, you're making 1% of $1,000 at $10. Whereas with leverage, if you've got 10x leverage on that $1,000, that means instead of only $10, you're making $100. Negative side being with leverage, that if the price comes down, you're also losing $10 instead of just $1. So I've opened one account here that we actually opened a trade for on stream a while back. And there's a couple key factors here. But basically what I've done is actually go for my own strategy, which is slightly different from what I just told you, but what I just told you is the basis line. What I've done on this account is just think about it, right? If you take a look at the Bitcoin price action of the past year or so, if I had always just bought every single time the price went lower, and I just kept that up, at some point in the near future, I know if we, for example, bought here once, 2 times, 3 times, 4 times, 5 times, 6 times, my average price out of all these would be somewhere in the middle. So let's say right around here is where my average price would be. If my average price were to be right here, then I know that even though it took some months, because I started buying back in November of 2021, and I only got into profit in November of 2023, it took a year. And so you'll pay some fees for that, depending on whether or not you bought spot or with leverage. If you did leverage, you have to pay some fees. But at least at some point, I'll be in profit. And in this case here now, that profit on that trade, even though it took some time, was 82% or 84%. And so what I've actually done on this account, I think it was actually just one buy, but it was about the principle that mattered, that it doesn't really matter where you start. It's about just getting the lower average price as possible and just not holding it for too long. What do I mean with too long? Well, we know we've got about a 150-week period, which is a long time, but it's not an infinite amount of time. My camera keeps dying, I think, because of heat. So on this account, it seems that I bought into this position at $28,500, and I put in roughly $1,300. Right now, this trade is sitting at $17.8 thousand worth of profit. So again, with only $1,300, right now it's in total worth $19,000. That's pretty good. And how long did it take? Well, let's say we bought it right here. I don't remember when we opened it, but that would have been roughly 40 weeks, so 280 days. Some might say they are able to do way better in a whole year. And I'd always say, you know what? You may be able to do better, but I sure as hell think that turning $1,300 into $20,000 in, let's say, half a year or a year, whatever, is pretty damn good to almost anybody. So how can this be replicated? Well, even if we were to get into the Bitcoin trading right now, you might say, well, but it's difficult because right now I'd start at 66,000 instead of starting like you at 27. But the thing is, just take a look. Wherever I could have bought at a way cheaper price a few months back. Right here, if I'd started at 15,000, the profit would have been way more insane, about double. So my 1,300 would have turned into $35,000 if I'd only started a few weeks earlier. And yes, that may suck, but I don't think about too much about what could have happened if I bought earlier. It's mostly about what is the price going to do in the future. So the idea now becomes, like I just explained earlier, a matter of, you know what, if I just start buying wherever, even if it's the highest of the highest point, if I just keep that up and I keep buying on my way down lower, at some point I know the price will be above where I got my average price towards right now. And if you're, forgot the camera is dead. If you're a little bit more afraid and you don't like waiting on it for a while, again, you don't actually believe in the system, you just kind of believe it, there's actually always the opportunity to just buy in the, let's say you buy it once right there, second time right there, third time right there, fourth time right there. Your average price will most likely, if you keep increasing your buys, so you start with $10, but then you buy $100, then you buy $300, then you buy $700, then your average price right now is, let's say, for example, right there. And that means that on this swing upwards, which by the way, is roughly 40% up from the last time you bought at, that you're able to sell it at this point for profit right there on that top, because your average price has moved from being 67,000 because you keep buying lower. The average price also keeps moving lower, 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 lower. Let's say your average price at some point is right there at, I don't know, I can't see the exact number. Let's quickly put this on the side. Your average price now is 37.8. You're able to make 27% profit. And with leverage, in this case here, it's 10x leverage. That would mean 270% profit on the trade. So where are the caveats? Well, the caveat becomes, if you're doing this with leverage, there are two things. One, you can see there's a liquidation price right here. What does this mean? Well, because I've borrowed money, right? I put $1,300 in and I'm trading with $13.5 thousand. From the point at which I started, obviously, if the price goes down a few percent, because I'm using 10 times as much money, I'm using leverage, I can only basically lose 10% from where I've started at. And that's where the difference between cross and isolated come in, which can be seen over on the right. Let me just quickly guide you guys through. So there's a little button here that says cross. And this, by the way, is only relevant for the people that want to use this extra leverage to make more profit. The whole strategy, which I just described to you guys, if you just do this with buying Bitcoin normally, it is, again, very hard to lose. I hope everybody sees the logic in what I've been shouting here. Again, a second question might be, is it even better to buy altcoins? But that's more difficult. This is like a foolproof strategy ever since Bitcoin incepted. Because once more, this strategy here of buying lower and lower and lower, it was more risky back then than it is right now, because this was the 50-week period, I think. Maybe it wasn't, but you get the idea. I think so. Of where prices came down for a year. This is the period still that we're in from about April 1st on forward, where usually it's 70 weeks of upwards. So if you're buying your way down lower, usually it does not take as long to flip back bullish like it did back here. Anyway, so on the right, we can see there's this little thing that's called cross. And if we click it, there's a few options: isolated, cross, and portfolio. So the difference between isolated and cross is basically this isolated. Let's say you have $1,000, right? This margin here, we have $1,000, you want to trade with that. Well, we can only use the whole 1,000, nothing more, theoretically speaking, we could use less, but just $1,000 is all we can lose. But that means if the price comes down roughly 10%, because we're also trading with 10 times as much money as we have, that means it's not a 10% down on our money, but it's basically 100% because obviously every move is multiplied by 10. If we used cross in that similar example, right? So this again, difference between cross and isolated, it tries to use your whole balance that you have in the account and other assets that you might have in your account to basically make sure you don't get liquidated. This price of $27,000, because right now in this account, if we take a look, can I quickly see, if I were to close this trade right now, for example, I'd on my account have $18,000, right, or $19,000, minus the $2,000 in fees for keeping this position open for like a year. We start out with $1,500. It's cost me, I think, in total a little bit more than this even, but it's been worth it thus far, as you can understand from the profit. If I were to take it out right now and open a new $1,300 position, usually, right, if I had isolated, that meant that I, from this price, so which would be 67,000, let's say, could go down roughly 10%. So let's say towards 60,000, and my money would be finished. So I'd have to either buy more and more and more to keep my average price as low as possible, so I'd never get liquidated or get a margin call, which basically means, hey, you had $1,000, or in this case $1,300. The price has gone down 10%, which times 10 means 100%, which means your trade right now, instead of being in profit, would have been at minus 1,300 or minus 1,000, whatever I used at that point. And since you only had $1,000, we have to close this position and make, you have nothing anymore. But if I had cross open like this right here, what it would basically do is take more money from my account to make sure that I can now, instead of just being basically, let's again use the example of $1,000. I cannot just, it might sound crazy, but I cannot just only lose the $1,000. I can use everything in my basket. And that means that if the price comes crashing down one day by 25%, but it comes back up quickly, I will not get liquidated. My P&L, my profit and loss, might look a little bit bad that day because the price went down 25%. Ooh, but I'll survive. My trade won't be closed. I will just have more of a loss. But obviously, if I use that to just buy at that point and then later on buy again, on the way back upwards, I'm able to turn it into way more profit. And so this basically means with cross, you're risking more of an account, but you can get this liquidation price to literally zero, for example. Let's say I have an account. Oh, wait, I'll show you an example. I think I can actually just explain it because I don't have any account right now that meets the qualification of what I'm trying to tell you. Let me just say the liquidation price that you just saw, which is usually the scary figure, it can be gotten to absolutely zero because even if the price just keeps going down and down and down, if you've got enough in your basket to cover for that slight downtime, and at that point you keep buying down lower, since you're never going to get liquidated because you've got enough money to facilitate the position even at a bigger loss, I personally think the risk is very minimal. Now again, what this will do is on your account things will look bad because you're going to see a bigger negative, a bigger minus, and to me that just means, hey, I've got to definitely buy more right now, get my average price as low as possible, because remember the 150 weeks up, 50 weeks down. To some, they think, oh my days, my trade is doing so bad, I'm at a loss. And that's the difference between having a short-term trade or a bigger swing. If you're somebody that likes to be in a position quickly and then back out, this is not a good strategy because it will hurt your brain. If you know that, again, usually it's 150 weeks of up, 50 weeks of down, because your liquidation price is zero, or let's say, for example, it was $10,000 because you didn't have enough money in the account to get it all the way to zero, or it's just $20,000 because we know, or we think, the Bitcoin will almost probably never go back to like $10,000 or $20,000, you're fine with that position. I don't even know what to tell you anymore. I think it makes too much sense. So in this case, how would opening, I switched back to the other account. How would opening up one work? In essence, you just take the price. You can do market if you're too lazy to set an exact price where to buy at. You, for example, buy $100 worth because we're using 10 times leverage. That's $10. We press buy long because, again, we think the price is going to go up. So you just press buy long. It will quickly usually give you a little overview. For me, it doesn't because I traded off, but it will ask you, hey, are you sure you want to buy right there, right now? If we turn on trade history, you'll find, hey, we just bought ourselves a little bit of Bitcoin right there. The other times don't show because I think it only shows the last 6 months. And you can also use a little calculator here for it to calculate everything up front if you wanted to see how much leverage is wise for you and at what point, for example, your liquidation may lie. Just go over to the calculator and try it out for yourself, for example. Or I think you'll also see it when you press buy long because usually, again, like I said, it gives you a little overview. And if we want to sell, we can just quickly press at the bottom here, like market or limit if we want a specific price to sell at, market if we just want to sell right now. You can try a trailing stop, you can try a take profit or stop loss. A stop loss is not recommended for this strategy because again, it's something you keep open for probably multiple weeks, if not multiple months. And a take profit, you can surely set in up front or add later. Again, if you're somebody who pays attention every week though, you can also just quickly close it whenever you want to. The reason to have a take profit at all times is because what if you have a crazy pump for like an hour or so, then your position will sell itself. The reason not to have one is because you might just want to keep it open for a longer time and you don't want to sell it. For example, let's say the price starts going crazy and goes to 74,000, which is where you have your sell at, but the price keeps going on to like 90,000. You already sold at 70, right? So you now are hating yourself perhaps. That's one reason not to have one. But again, a reason to use isolated is because let's say you have $1,000 in your account and you don't want to risk your entire balance. You just want to risk the $1,000 and you're fine with this liquidation price, or you're going to just actively buy down lower. Then yeah, that's fine. It's inherently less risky, while on the opposite side being more risky. It's less risky from the perspective that you know exactly what you can lose. So it's less risky because you know everything up front. It's more risky from the perspective that, in my opinion, at that point, there is a chance you're not quick enough when buying the dip. And it means you're not comfortable enough with risking it all for the big swing, for the big trade. And at that point, I tell people it might be just wiser to go for spot or perhaps like a 3 times leverage spot position, which is also possible. On the opposite side, if you think that you really are going to be there buying the freaking dips and a swing of swords won't hurt you because you've set your orders up front, it is also fine. It's just not my own personal strategy. But if we have to summarize here, the simplest strategy throughout time here has just been to buy and understand that even though there are some coins out there that will make you more profit, guaranteed there are, this has worked thus far. It has always worked. It will keep on working. Some sucker will comment saying, oh, he made this video just before the price went down 10%. Again, if we look at what I've just shown you, as long as you just keep buying down over the next few weeks or months, you'll be able to turn it into a profit. This is not financial advice. This is just the numbers I've been showing you here. Again, please prove me wrong. If you had anywhere in the past history of Bitcoin ever bought it, you'd right now be at profit. Oh, but if I bought last week at 74,000, I'd not be at profit. Well, if you bought at 74,000, let's say, right, a week or a few weeks back, and you did not buy the dip at $53,000 or anywhere in the 50s in these few weeks, you're playing the game wrong, because the idea is wherever you're buying at, make sure that every time it goes significantly lower, and the price went, let's see, the price here went 30% lower from that previous price. If you are not ever buying dips, then this is hard. But if you're able to buy more, and again, you believe in the long-term strategy, this is amazing. So again, I'll leave a couple of exchanges I personally am using down below, like Bybit, like OKX. You can do this with either leverage or no leverage. Leverage being obviously more gains while also having inherently more risk. No leverage being obviously less gains and also less risk because you can't get liquidated. But it's harder to turn $1,000 into $20,000 if you're not using leverage. And you might say, Dusty, timing is all that matters? Yes, but no. The better you time it, the more your profit will be straight away. But understand that this position that you're looking at the whole time here might look good now. Just know that this position, because I started with $1,500, was at a significant loss for a while first. Let's say, for example, I open it up right here, right? Let's say I open it up right here on August 7th. I don't remember exactly, but let's say I did. The price at first was at a very, very steep loss. So I think I had to, no, I'm not so sure exactly where it was, but you get the idea. Because it is cross, it was able to use slightly more of my balance, maybe, to make sure I did not get liquidated at this 13% or 17% move. And eventually, because I just left it, because I kind of forgot about it, I looked back at it a few months afterwards, and all of a sudden is at this crazy amount of profit. You will not have this if you're not using leverage, because obviously our position would have been up a lot. It would have turned our $1,300 into, let's say, so almost $4,000, let's just say, to be very easy about it, which is obviously a ways away from the $20,000 we're at right now, but nonetheless, still pretty good. I think it makes sense. If it doesn't, let me know down below, and I'll definitely make another video explaining it better. But I'm just trying to help out some people that are finding it hard as to where to get started with trading crypto. I think this is the easiest method. And even though it takes patience and is not as rewarding every day, because again, I don't look at this position every day. I look back at it every few weeks or so. Whenever I talk about it in a video, I look back at it. I can sell it now just to cash in my 20,000. But I know that ultimately this is the 70-week period, and we're about, let's say, 15 weeks into it. this is the 70-week period where usually things start popping off and going crazy towards the upside. So I'm happy with just holding through. The only thing is, because this average price is so low, because it's just $28,000, it's a little bit annoying to buy dips because it will only increase my average price. So I prefer to do it on a different account, just so it doesn't mess up the balance I've got going on here. But for most people, that won't be too much of an issue. Just get started. I've left a link down below to Bybit. You can also claim yourself a free trade, probably. If not, it'll be fixed soon. I'm going to make sure everybody is able to get themselves a free trade over on Bybit. But yeah, that's about it. See you guys soon in another crypto video. Take care.